Street Journal with your excellent piece, and you're saying, and I think rightly so, well, the oil rise is not going to doom the economy. I agree with that. But, Don, there's some collateral damage. Gasoline is causing inflation. Consumer spending is slowing down. You know, the first quarter is going to be a lousy quarter. 2% growth or less. Consumer spending will be about 1%. And I want to ask you, is gasoline and energy and raw industrial commodity prices going to bite into corporate profits? Stephanie says no. She is the Dr. Pangloss in the Voltaire novel for this program. I want to ask you, are you being more realistic than my friend Stephanie Link?
Well, I hope we don't have to explore all the details of that novel, which involve, as I recall, losing body parts and just some really bad things. But look, as you said at the top of the show, I guess I'm somewhere in between. It's not a gift to see oil prices at 105 in the U.S. and 115 on a global basis. The question is whether it's a tipping point. And no, it's not a tipping point. It's temporary. It's not throwing the economy into recession. This political turmoil in the Middle East will pass. The one thing we know is no matter who is sitting on that oil, whether it's a sheik or a sultan or a revolutionary or Jed Clampett, in the end, they are going to sell it to the U.S. Don't worry about that. There just may be a month's delay, and the Saudis will even help us through that. So it's all good. And if we have a little bit of a disappointing first quarter, don't worry about it. The reality is that corporate earnings are at an all-time high, but the stock market isn't. Are you seeing the mismatch there? It's time to buy them.
I get that, but I am to some extent paid to worry, at least to report the worries. And let me just ask you, this is a flyer, Don, but the reports that the Libyan rebels, whoever they are, I don't know them, I've never met them. Some people think they're al-Qaeda terrorists. I have no idea. Some people think they're pro-democracy yuppies. I have no idea. But the reports that Libyan rebels will sell oil through Qatar, is that bullish? I mean, would that have been a sort of missing link in the bull story today?
Sure, it means that there won't. We're not even going to have a temporary disruption there. You know, I mean, Lord knows, Larry, why we've chosen the sides we've chosen in this war. This is what happens when a Nobel Peace Prize winner goes to war, I guess. But in the end, the oil will flow. Don't worry about it. If we have a little bit of a disappointing first quarter, we're just going to make up for it in the second quarter. We are out of recession. This economy has tremendous momentum. Look at the stock market, Larry. Look at it. We are less than 2% off recovery highs. We are up 5% from the correction lows just 2 weeks ago. The strength behind this thing, it's trying to tell us something. We have only to listen.
All right. Well, we have only to listen, Larry Glazer, but you got to listen to a lot of different sounds. I want to throw the same corporate profits question to you. I mean, I think it's corporate profits in the Fed. Right now, it's not Libya. It's not the Japanese disaster. I don't see much coming out of Washington, D.C. Maybe next week we'll worry about a government shutdown, be that good or bad. But, Larry, tell me about the Fed. Talk to me about the Fed. Sure. Speculate for me. Will the Fed end its pump priming in June?
Sure. Well, Larry, to the extent that weak housing and weak consumer confidence keeps the Fed in the game, the reflation theory and the reflation trade is alive and well, isn't it? And we know that the housing market is clearly not responding to what is happening. Something's wrong. There is a disconnect. Perhaps higher rates would actually be better for the housing market because it would defend the dollar. Perhaps that would allow buyers to be able to afford gasoline to buy homes outside of major urban areas. So we have to be open to new ideas and trying new angles, but the data keeps the Fed alive and engaged, and we don't know if that's a good thing in the long run,
How are you
Larry.
playing this? What's your investment strategy, Larry? What are you buying here?
Sure. And Larry, I don't want to be painted as a bear here. I think I'm cautious, but I'm also trying to be a realist.
In this crowd, you're a bear.
Sure, okay. And I respect my colleagues' optimism, and I hope they're right. But I think there are plenty of opportunities for investment. You know, when we look at the 52-week high list, I do get cautious in some of the cyclicals because it is entirely possible that the global growth story could be derailed. However, there are plenty of opportunities for investors on the equity income side. For that investor sitting at home watching this show, sitting in cash, they know they're earning nothing. They're afraid of the market. I don't blame them. Get engaged slowly, gradually, put it in less volatile areas, dividend-paying stocks. That's a way to participate for the weary.
All right. Stephanie Link, in your heart of hearts, I'm going to do some brief psychoanalysis here, okay? This is great fun. What you are really betting on is that the Fed keeps priming the pump. Is that not right? You expect the Fed to continue after QE2 and keep pump priming. Isn't that at the basis of your desire for the stock market that the wave of liquidity will continue to drive stocks higher until such future point as we all crack up?
I think it's critical they remain flexible.
Flexible.
It's like the training wheels. You take them off a bike and you see how it goes. And if you need to put them back on, because it gets a little shaky.
2 years out, we're in a recovery. We keep zero interest rate. We keep flooding the market with reserve, keep destroying the dollar. But that's good for stocks. I admit it. In the short run, it's great for stocks.
They need to focus on jobs, okay? You have to come back to that, right? And he can't start raising rates and taking away all this liquidity when you have a fragile job market.
So I'm right. In your heart of hearts, you're betting on the Fed to keep pumping.
I'm betting on them remaining flexible. If they need to do it, they'll do it.
All right.
And if they don't, then that's a good thing, actually, right?
And now
so that's a win-win in my book.
And now that's right. The Fed cannot lose. The market cannot lose.
Stephanie, is it a win-win if grandma can't afford her rent and she's running out of money because interest rates are 1%? Is that a win-win? It's a speculator's tax. I appreciate your perspective, but I'm not sure it's a win-win for the entire economy.
I don't think it's a speculator's tax. I think that's totally wrong. A speculator's tax.
It's housing speculators. We're paying for housing speculators through low rates. That's what I meant.
Housing is about 2% of GDP right now, so it's really not even all that much more important. Jobs are more important. That's the thing that we got to get fixed, and fixed fast.
Hey, Don Luskin,
I agree with that.
Don Luskin, if the dollar were convertible into gold, as per Lou Lerman and a few others of us, the oil price might be about $25, $30 a barrel. Where would that put the Dow Jones? 20,000, 25,000? Think about that. Stephanie wants the Fed to keep rolling those printing presses. I get that. She's probably right. In the short run, it's very good for stocks. I think in the long run, it's a disaster for stocks. What do you think?
It's always the problem is always in the transition. If we could somehow stabilize everything and rebuild the world, we would certainly want gold convertibility. We'd certainly want a zero inflation rate. The problem is that isn't the initial condition. That's not the world that we've been handed. It's not the hand of poker we're playing. We're playing a hand of poker in a world where the economy has been severely damaged. The credit system of the world has been severely damaged. In order to get people to dive into the pool, we have got to fill that pool with liquidity. And that's what quantitative easing is about. So we do not want to go back to a tight money world.
Boom, and it's going to work for stocks until it doesn't. Now, there's another factor out there. We've got some new news. The crisis surrounding Japan's stricken nuclear power plant deepens. And now we can expect some disruptions in the supply of auto parts coming out of Japan. CNBC's Kaori and Joji joins us now from Tokyo with the details. Hello, Kaori.
Hi, Larry. Well, it seems that we've entered a new phase in this nuclear reactor crisis in that people are thinking that we've entered a new phase where the cooling operations is disrupting the contaminated water situation. What they're doing is they've been able to keep the temperatures relatively stable for the last couple of days by dousing these nuclear reactors with water, but they're also dealing with a huge pileup of contaminated water that's already filling the trenches. And they seem to be improvising over the last 24 hours, trying to prevent that from entering the sea because the trenches are already full and they're building sandbags around some of these reactors to try and contain this contaminated water situation. Corporate Japan, 18 days after this quake, trying to get back on its feet. A lot of concerns about the supply chain, but Honda is saying that they had about 110 suppliers in this quake zone, but most of them are up and running or have resumed production. Some of the analysts still concerned about some of the export-heavy sectors like technology as well. Toyota in particular, because it relies most heavily among the automakers on some of the exports. A lot of suppliers we're talking about Renaissance Technology in particular are worried because they make the microprocessor units, about 60% of the supply that they need to go into these car makers. Larry?
All right, Kaori and Joji, thank you very much for the update. Let me go back to my panel. Stephanie Link, Larry Glazer, Don Luskin. Larry Glazer, is there an impact now from the Japanese disaster, an economic impact? The human impact is incalculable. Absolutely. But in terms of our economy and our market, no one seems to be talking much about Japan. It's not solved. There are radiation risks, and there are, of course, supply chain risks.
Sure. Well, Larry, and we talk about why investors may want to be cautious going into earnings season, because we will find out what the impact of not only Japan and potentially supply disruptions in technology, but also those impact on energy and higher commodity prices will be in corporate earnings going forward. So it may not show up this quarter, but maybe next quarter we start to see that there was a temporary disruption. Now, that may be overcome by very inexpensive valuations in Japan specifically, but we may see it here at home.
Are you buying Japan, Stephanie? Do you do that sort of thing? You go global?
Well, we do if we do, but I think there are a lot of bargains here that have exposure to Japan that you can buy and get on sale.
One bargain.
Well, I like General Motors a lot.
GM, terrific, Government Motors. Don Luskin, give me your favorite investment right now on the way out, please.
Freeport-McMoRan.
Gold, mining, copper. So there's
Copper, cyclicals. It's the perfect growth combo reflation play. You gotta love it. Something for the entire family.
Nothing if not consistent. Totally consistent. Thank you.